This has been an administration that's prided itself on deregulation. But then you see things like the suspension of enforcement of the Corporate Transparency Act, and you look at pardons of certain individuals who were found dead to rights for being involved in some fairly nefarious activities. Big fines discourage banks, and they have short memories. The enforcement, the stick, has to be part of this collective ecosystem because if you're not punishing those who would flaunt the rules, it doesn't create that line that is used as a deterrent.
Blood Money Media. Just for my guest, let me introduce Daniel Tannebaum, who is a partner at Oliver Wyman, where he leads the firm's global anti-financial crime practice. He is also a non-resident senior fellow at the Atlantic Council's Economic Statecraft Initiative in the Geoeconomics Center. And he's been doing this, as he may not want to be reminded, for a couple of decades now, including starting his compliance career as a compliance officer with the Office of Foreign Assets Control at Treasury. So, Daniel, thank you for joining me.
Thanks for having me. Yes, that was in the kinder, gentler days of the second Bush administration.
That's right. When I think Treasury and sanctions were really you all helped to build the platform to where it has gotten to today.
I was a peon at a time when sanctions became a much bigger part of the foreign policy toolkit. So I definitely saw that from the inside.
Well, I want to get your perspective on where we are with Trump 2.0, his sanctions and AML policies. We've seen a number of different policies rolled out. Some I imagine you might applaud. Some you may be more circumspect about. So, but I just want to get a sense of how you view the current state of anti-money laundering efforts with the Trump policy. How would you characterize it?
I think the most succinct way I could characterize it is confusing because it's a bad answer, but I'll expand on that. At the onset, this has been an administration that's prided itself on deregulation, on trying to remove burdens for financial institutions in the compliance space in terms of facilitating and encouraging mergers and acquisitions in the financial services space. But then you see things like the suspension of enforcement of the Corporate Transparency Act, and you look at pardons of certain individuals who were found dead to rights for being involved in some fairly nefarious activities, even really cases against individuals that were in the works for committing money laundering that seemingly have vanished. So it is a bit of mixed messaging in terms of the priorities out of the administration. I think sanctions had certainly been an increased focus on Iran related to drug trafficking. But as we saw just a few days ago on October 22nd, that was actually just the first time the president used sanctions on Russia since he took office again in January. So, when you take it as part of the whole, you see an administration that kind of is talking out of both ends, frankly. They say that they want firms to focus on fighting financial crime, but removing burdensome activities from their ecosystem that aren't accretive to managing risk. But then they're deprioritizing things like companies disclosing who owns them, which is kind of a helpful tool in the fight against financial crime.
It was a top priority for several administrations, including, I might add, the first Trump administration, correct?
The first Trump administration and a heavily bipartisan Congress, actually.
Yeah.
So when I step back, I'm kind of confused by what companies should take away from some of this mixed messaging.
And let's just dig into that a little bit. So, on the one hand, There are attacks on drug trafficking boats, as far as we know. That is the allegation, as the DoD has put it in the White House, that they're trafficking drugs. There's not much evidence left that we can see, but let's, for all intents and purposes, say they confirm that they are trafficking drugs, and that is a disruption, and does send a signal to the cartels that there's some seriousness with which they're taking the fentanyl and the narco trafficking. But at the same time, you mentioned the rollback of the Corporate Transparency Act, which the Treasury said in its own release about China and Iran. The notice yesterday: shell companies are at the center of these operations, these cartel operations. So I don't understand. Does that help in helping ferret out who the illicit actors are financing this?
Well, I think if I recall correctly, foreign companies would still have to disclose. It was domestic companies wouldn't have to disclose beneficial owners, but that's kind of the point, is looking through these shells to understand if there's foreign ownership, which now you kind of kick the stool out from under that point that I know law enforcement is still quite vocal about.
In what sense? Can you explain?
In the value in having that beneficial
Yes.
ownership information as part of their investigations.
Yes, and if you're setting up a company in the U.S., then it's a U.S. company, even if it's owned by a foreign agent, say through the British Virgin Islands, or U.S. Virgin Islands, or Delaware. Then it sort of negates the whole point. Correct?
That's right. Again, I mean, to my point at the onset, it's confusing. I think,
Yeah.
you've had companies, and I spend my life now as an advisor in the private sector to global financial institutions. You have companies that spend an aggregate of tens of billions of dollars a year to fight financial crime. Is this the most effective and efficient process? Like, not by a country mile in terms of the amount of effort expended relative to risk identified. That is definitely a key part of the broader AML reform initiative, to try and close the gap between how much money is spent relative to the actual bad actors that are found and then purged from a good economy.
And penalties themselves, penalties, whether by sanctions, or fines, or criminal prosecutions, those are not just actions that affect the targets. Those are meant to serve as inhibitors for the greater terror finance or money laundering operations, as in a sense to deter them. So if what does it tell those money launderers, terror financiers, autocrats, corrupt dictators? What is it? What message is the Trump administration sending in its actions or lack thereof?
Uh, I think about that a lot. And granted, look, it's still early days. Enforcement takes time. We saw three bank enforcement actions in the US last year that were not so insignificant, one much more significant than others. But to your point, I grew up at OFAC. OFAC became notorious for large fines, for the big bank stripping cases that dominated kind of the early part of this century, for fines related to Libyan, North Korean, Iraqi, Cuban activity. But those fines ended in 2019, and companies have a short memory. If I take the crisis in Ukraine and firms that are continuing to operate legally in Russia, I mean, you have Austrian and Hungarian banks that are actively operating in Russia. And, without real fear, frankly, of the consequences, taking comparison when the JCPOA was enacted in 2015 and secondary sanctions were lifted, John Kerry, when he was Secretary of State, and Boris Johnson, when he was the Foreign Minister of the UK, assembled the largest banks together and said, you can do business in Iran again. It's now legal outside of the US. And one after another, all of them said, absolutely not. And like that was a scenario where the business was legal and they were still afraid of being on the wrong side of the US. Now you have a scenario with Russia where, yeah, the work might be legal, but the line of legality versus sanctions violations is pretty thin. And you have firms that are part of the Allied coalition trying to fight Russia who won't exit the market. So I do think that enforcement, that stick, is a real critical part of the entire enforcement ecosystem.
And if you mentioned some bank fines. We were thinking about BNP Paribas, HSBC, where you had multi-billion-dollar fines, and they effectively shook up the compliance industry. Just those two alone, didn't they? They forced banks to recalculate their exposure to risk.
Well, so it was not just the fines, it was the activities ordered as a consequence of some of those fines. So the monitors and independent consultants that were ordered as a result of some of the larger actions. And I can say this having served now twice as a US government appointed independent consultant, those might not have universally been the most productive exercises. In some of these firms,
The
you had
monitoring or the fines?
the
Mm.
monitoring, because you had firms that were not incented to release banks from these orders. And I'm not saying that, these banks were all like perfect going into them, but in one instance, I was brought in to replace a longstanding monitor and IC that had been in this bank for years. And bluntly, I kind of came in and looked around and said, what am I doing here? Like, this bank, like, is it perfect? No. Do they run a good program? Yes. So I had to go back to the regulators and say, if you're looking for perfection, then I think you're missing the point. If you're looking for risk-based, then I don't know what I'm doing here, because they're generally fine. And so I do think the monitorships drove an elevated standard. Not that it was wrong, but it was certainly moving the needle more rapidly than you might have seen otherwise. And it created almost a disincentive for these firms to release firms from the troubled condition that they were in.
And going back to the punitive measures, sending signals, does a um, uh, do small fines for major offenses, do they discourage banks
No,
or actors? No.
big fines discourage banks, and they have short memories. If you take the examples of those eye-watering fines in the sanctions cases, they ended in 2019. People forget. They have short memories. Or I have clients who will say, well, we could never do that. I think the fines, the enforcement, the stick has to be part of this collective ecosystem, because if you're not punishing those who would flaunt the rules, it doesn't create that line that is used as a deterrent. I mean, enforcement has absolutely worked as a deterrent. I think Iran related enforcement was probably the best example. And that 2015 example I provided, where companies wouldn't even engage even after it was legal for fear of potentially violating what was left of those existing regulations.
So what when you go to the administration and say, look, we need clarity, what sort of clarity are you looking for?
Here's what I'm after. I've spent decades in this ecosystem, and I've been a chief compliance officer, I've been in government, I've been an advisor to firms. So I've really seen this all the way around. I think there's an incentive misalignment between all the parties in the ecosystem. And when I talk about the parties, I'm talking about policymakers from a treasury standpoint, policymakers from a regulatory agency standpoint, supervision teams on the ground, the regulated institutions, and law enforcement. And if you ask each of them the question of why are we doing any of this, the activities related to prevention of financial crime, the answers are not going to line up all the time. So I do think there needs to be a clear collective mission that gets at why are we doing this? Like, what is the point of this fight? Because when I work with a lot of larger financial institutions and I look at their reporting to regulators, to their board, they'll talk about we've completed 800 of 1,300 milestones in our plan. And like, that's great. None of that tells me how you're managing your risk. And so outcomes based focused on actually ridding financial institutions, economies of bad actors, looking at this from an outcomes basis collectively where everyone's really joined up on the same objective. I think that helps a lot. Firms don't know how to define what good looks like in the sense of drawing a line in the sand and saying for KYC or for suspicious activity reporting, here's the data we know where we're deeming this program effective. It's very much defensive in nature and trying to satisfy supervisory concerns almost more than managing risk. So when I talk to the administration, that incentive misalignment is probably the biggest piece of the puzzle of if you ask that why question to all parties in the ecosystem, will they have the same answer? If the answer is no, then I think there's a problem.
So help me to understand that a little bit. I mean, banks are companies, and they have a bottom line. Their primary goal is to return revenue for shareholders and their investors and owners. So they're not moral institutions. They are established to make money. So that's why there are the regulatory incentives to meant to encourage or discourage activity that is a threat to national security or security in general. When you're talking about alignment of purpose, uh, can you give me a couple of examples about what you're talking about?
Yeah, and I think, and to your point, financial institutions are not agents of the government. Like that, is although, that may be debated in different camps.
Yeah.
I think this is where AML reform comes in because you have banks spending a fortune to find a needle in a haystack in a much bigger pile of haystacks. Um, and that comes at a cost. But if you ask executives why they're doing this, a lot of the answers are going to be to keep the regulators off our back. It's not because we really don't want money launderers, drug traffickers, human traffickers using our rails to finance their activity. And I think the changing regulatory environment may help get them more in line with what I'm thinking. Because the whole point, at least as I understand it conceptually with its AML reform agenda, is to focus on risk management above all else, on activities that are accretive to keeping risk out of these firms. And that is something that's going to take time for executives in financial institutions to migrate the mentality of just box ticking to really focusing on when it comes to these activities where, the boards of directors, the appointed AML officers, the executive teams do have an obligation under the law to police their firms for these issues. I think it may reinforce the why within a financial institution to get them away from a focus on doing things for the sake of doing them. And like you'll see banks that have a 1% conversion rate on transaction monitoring alerts for SARS, which means 99% of the things they're doing are worthless, to really focusing on how do you increase that percentage where the activities that you're doing really generate a return in the sense that you're identifying actual money laundering or sanctions evasion risk. And that's where I do think the alignment joins back up with the governmental ecosystem.
And the messaging and the incentives and stick.
Has to be there. I
Yeah.
mean, again, to the example I used when I was when I was an independent consultant, was we found that of 700 systems in one bank that were validated, maybe like 10 didn't get appropriately validated from source to surveillance, but they were immaterial systems. Or of thousands of sanctions alerts, a handful weren't dispositioned according to policy and procedure, but the right decision was rendered, which means the bank bore no risk. So, like, if I'm looking at this from a risk-based standpoint, I don't care that they didn't follow policies and procedures. I care whether or not the right decision was rendered. And that's not universally the supervisory mentality today, but I do think that is where this reform initiative will push things and should hopefully create a change in behavior in the institutions to focus more on risk management above box ticking.
You're talking about the reform initiative within Congress.
Well, the reform initiative, not just, well, no, I'm talking about the reform initiative within the Trump administration
Hmm.
that has been talking since the earliest days around looking at the AML ecosystem. And Undersecretary Hurley gave a speech a few months ago at a money laundering conference where he really talked about we're really trying to look at this entire ecosystem for what it needs to do versus how it's historically operated.
Got you. And thus the tweaking of the SARS reporting data, guidance on that, the rollback of the FCPA.
Well, maybe not that, maybe not the rollback of FCPA, but certainly the guidance, the FAQs that came out around SARS was an important one to try and reshape activity that's been done for questionable reasons, whether it was the way the documentation for no files for alerts were handled, where continuing activity reports were handled, and what's now being talked of as a misinterpretation of the Bank Secrecy Act in the first place, and the way things have been interpreted. This is where it gets back to my message at the onset of this is a confusing time because you see things like a push to heighten the effectiveness of the AML ecosystem. But then you do things like you pull back on the FCPA, which is not AML related, I grant you, but still within the broader financial crime umbrella, it leaves you with questions of how is this going to net out in the end?
And where do you think the disconnect is?
I'll be honest, I don't know. I mean, I don't think anti-money laundering regulation is a top of house priority in this administration. I don't. You saw in the previous administration when certain enforcement actions were being rolled out in the AML space, the Attorney General Merrick Garland was the one who announced them. I don't know if you're going to see that same focus here. There's a lot on this president's agenda thus far into this administration. And I think what we've seen where AML fits in is part of the deregulatory agenda of removing burdensome activities that have stifled growth of financial institutions. But that is a bit of a challenge. We're not talking capital requirements here. We're talking the requirements around a bank's need to police their rails for bad actors, for sanctions evaders, for money launderers, for drug traffickers. So I do think there might be not the most joined up approach at present for how to tackle these issues.
And if you're not leading from the top, then a secondary policy or something that's treated as a secondary policy will get overlooked.
Well, and then you see Congress weighing in, which is not always the most helpful. If I look at things like the Streamline Act, raising the CTR threshold and a justification being, well, it was enacted in 1970. It was $10,000 for CTRs in 1970, I think, which equates to 65 odd thousand dollars in 2025. I don't know. If someone brings $10,000 in cash into a bank branch today, that's probably more suspicious today than it was 50 something years ago, given the evolution of digital payments.
Mm.
So I do think, again, there needs to be a thoughtful approach to how these rules are changing because there's definitely some mixed messaging out there. And it's not that simple for financial institutions to just change their operating model that they've spent an absolute fortune building up over time.
Daniel, I'll leave it here just for time's sake. Thank you for taking the time to share your thoughts and insights on this. I really do appreciate it.
Absolutely. Thank you.